Hey, it's Alpha from Trade with Alpha, and today we're going to go over 6 golden rules every day trader should not only know, but demonstrate as well. So why is this so important? Well, as a day trader, you have a strategy that you use for each one of your trades. Now, when you incorporate these rules and principles into your trading plan, not only do you increase the odds of you becoming successful, you also get a better understanding of how the market performs. And this in turn helps you manage your trades even better than before. It's important that you follow along and pay attention because I can assure you that these will definitely improve your trading style and make you a more educated and disciplined trader. So without further ado, let's get right into it. Rule number 1, manage your risk. Risk management is the most important principle that you will come across in your trading career. The reason being is because it gives you the ability to grow an account exponentially or even deplete that account. It's all about how you manage those funds. And I'm here to tell you that if you place an emphasis on these risk management techniques that we're going to go over, then you will see positive results. So let's start off by going over the definition of risk management. Risk management is the ability to identify, assess, and limit risk exposure when managing a position. So essentially what this is saying is when you go into a position, you have to understand whether or not you're capable of managing that risk. And right before you go into that trade, you should be following your trading plan that you set up prior to executing that trade. So you need to determine a trading plan that meets the risk to reward ratio. And we'll go over the risk to reward ratio on the next slide. So once your plan is executed, what you need to do is observe the price action and mitigate the risk. And that connects to my next point, which is use stop loss to reduce risk exposure. When you see that stock is breaking out from where you bought it, you have the opportunity to move up your stop loss and minimize your losses. Worst case, it doesn't break out, but it touches your stop loss, you're out break even. And I'd rather have you break even than take a big loss. So when you have your trading plan set up, you should have a clear mind. You should follow through with your plan and see how the price action reflects based on your plan that you set out. And if you see that it's running well and there's a lot of buying power coming in, then you should let it run. And that's what I mean by allow your winners to run to calculate profit targets. What that means is you shouldn't be greedy. So say you're purchasing a stock that's going to break out of the $5 mark and you're looking to take profits around $5.50. If it hits that $5.50 level, you should pull out and be satisfied with your profits. Because if you say to yourself, hey, it's going to run to $6, then chances are it might go to $5.75 and come back down. And at that point, you have to accept a loss that could have been a profit that was already calculated. So it's important to cut losses immediately when it's not following your trading plan. If you have a look at this chart from TOPS, this is a perfect example of how you can manage your risk accordingly. You can see that this went up to $198 before selling off and testing $2 again. Now we were looking for that $2 break, and that's what everyone is anticipating. So what's important is that you should have a trading plan that allows you to capitalize from this breakout. In this case, your entry would be $2, and then you would have stop loss at $190 just to give it a bit of room in case it's choppy, and your profit should be around $230. And you can see in this case it ran from $2 all the way up till $250. So in the example I provided, you're risking 10 cents for a run of 30 cents. That's a 3-to-1 ratio, which is excellent. After it had this run, it sold off. And what's important to note over here is that it was coming back up to this 250 mark. So your buy order should be the break of that 250. So whether you place an order at 251, 252, 253, I would say that's very safe because once it breaks out, a lot more buying volume is going to come in and then it's going to run up to 275. However, in this case, you can see it touched 250 for a second time before selling off. So it found support at 215, which is bullish because it was making higher lows and wanted to test that 250 level again. However, this is a double top. So it sold off at 245 before hitting a support level at $2. Now in this case, if you're a dip buyer, you would have bought at $2 and sold for a scalp of 5 or 10 cents. You can see it went from $2 to $2.10 before coming back down. And at this point, it actually cracked the support level. So this was failed support and it came back on down to 175. This table is very helpful in the sense that it gives you an idea of how much you should risk for your reward. So let's go through this together. You can see here if you're risking $50 for every $1, then you need a 98% win rate, which is very difficult to achieve. However, if you change that risk to reward ratio to 3-to-1, then you only need to win 75% of the time in order to be successful. But let's see what happens when you're risking $2 for every $1. You still need a 67% success rate. What does that mean? Well, 67% of your trades have to be green in order for you to break even. But look what happens when we flip the table around. So now you're only risking $1, but you're looking to make $2. So you only need to be right about 33% of the time. And guys, that's very achievable, 33%. That's fairly low, especially if you get a good understanding of how to trade these stocks. Now, those stocks that go parabolic, we usually see this level over here, where you're getting $3 of reward for every dollar you risk. And for that, you only have to be right 25% of the time, which is very low. My recommendation is that you have an Excel spreadsheet where you log all your trades, where you calculate your win rate. Because once you calculate your win rate, you can come back to this table and see what your risk to reward ratio should be. But what you should aim for is to gain $2 for every $1 that you risk. This way, you only have to be right 33% of the time and you're breaking even. For instance, you should be risking 10 cents to make that 20 cents. And in most cases, that's what we see. Every morning, if you look at these setups, they're running 20, 30 cents. And when you're putting your order in, then you should only be risking about 10 or 5 cents in order to get that perfect ratio. So definitely do keep this in mind and make it part of your trading plan. Rule number 2, stay disciplined. When you're trading, you should have a clear mind. You shouldn't let distractions get to you. What I mean by that is if you look at stock twits, you see people saying, oh, this is going to go up, it's going to go down, and it really gets to you. So you should take a step back and stick to your trading plan. And you should really control your urge to trade when times are slow, such as lunch hours. If you've been in the market long enough, you've seen that the slowest times are usually between 12 and 2 p.m. But you do see breakouts happen around 1 or 1:30 as well. So I usually stick to lunch hours around 12 p.m. to 1 p.m. And during these hours, the volume dies down. So if you see a setup forming, just be very cautious. Just know that there's a chance that it may not break out like it's supposed to, and that's only because the volume has faded away for lunch hours. Another important point I wanted to raise about staying disciplined is not to chase stocks. Every now and then you'll see a stock on the high day momentum scanner and you'll feel like jumping into it. But instead of chasing, you should just give it a quick thought and think, is it reaching any resistance levels? Is this bullish? Is it above the 13 EMA? Is it above the 50-day moving average? Or is it bearish? Is it below all those indicators? Or is it just a pump and dump? Is it because there's a chat room talking about it and there's just a bit of hype which is going to fade away in the next couple of minutes? When you recognize that, then you'll have the ability to know whether or not you should go into that stock at the next setup. And making yourself self-disciplined will actually take you to the next level because it will help you evaluate your actions and reflect on them so you're better prepared next time. Rule number 3, learn and refine. We live in an age where so much is available to us. You look at all these chat rooms, these forums, these discussion boards, and you can see that there's a lot of collaborative effort of traders trying to figure out the next stock that's going to break out. And you can also get a grasp of these strategies that are used by following certain mentors. You're better off following these mentors because they've been in the market for quite some time and they've seen the worst, they've seen the best, they know what works and what doesn't. They're giving you that advice in exchange for a small fee, but do understand that the knowledge they're passing on to you will only benefit you. If you're a beginner and you just got into the market, you should recognize that these traders have tested everything and they're giving you that advice. So you should really listen up and be thankful for it. So gain as much knowledge and exposure as possible as it will add to your success story. I want to see all of you become successful, and that's why you're here. You're putting in time, you're putting in effort, and I believe in you. But at the same time, you have to learn, you have to refine your strategy, you have to self-reflect to understand whether you're capable of achieving that next trading level. Observe trading videos and lessons to learn from others' mistakes at their cost. Every mistake costs you. If you have a bad trading plan and it doesn't go your way, you're out by $50, $100, $200, whatever it may be. But if you learn from that mistake, you can make that money back. But what happens when you're watching someone else's video? Then they're paying the cost for it, but you're learning the lesson. So just keep that in mind. Reflecting back to when we were talking about the Excel spreadsheet, you should track your performance and use the tips and recommendations from these video lessons in order to boost your own performance. And this last point is very true because the markets are constantly changing and you need to be able to adapt to that. The way you adapt is by being educated and having an idea of what the leaders are doing. So have a look at Market Watch, have a look at CNBC. All these news outlets, they report the news first. And you should be listening to it every day so you know which direction the market's going towards. Rule number 4, no trader psychology. The market movement is caused by traders. Whether they're buying or selling, it's all price action based on traders' decisions. And these decisions form a pattern on the chart known as price action. If you have a look at this price action, you can really understand the thoughts and the processes that traders are going through in order to make these trades. So what you need to do is understand trader behavior and actions that are reflected in charts. Once you recognize the price action, then you can capitalize on these repetitive behaviors. You also need to sense the market sentiment to determine the direction of movement. So if you have a look at stock tweets or Twitter, you'll get an idea of what people are saying. Although you shouldn't let it influence you, you should always keep in mind that it helps you sense whether or not the market is overall bullish or bearish, and if more people are focusing on one stock than another. Lastly, it's important to have a positive mindset. If you want to exponentially grow your account and if you want to be a successful trader, then it's essential that you maintain a positive mindset that demonstrates confidence, and you should also be determined to succeed and not let hurdles get in your way. You'll notice every now and then that you'll lose or you'll have a bad day, but you shouldn't let that get to you. You should use that as an opportunity to get ahead and make bigger moves. Rule number 5, master your strategy. What I mean by this is everyone has a set strategy. We've seen all sorts of strategies in the market. Some of them work, some of them don't. You see people selling this strategy, you see people testing this strategy, and there are a few that I've seen that work majority of the time. And you should always learn these proven strategies from a successful trader because that helps you form a base and gives you a bit of guidance as to where to start and how to grow your account. Take that strategy and understand what makes it so profitable. And then you can adjust it to incorporate your own principles and rules that you think is important. So now that you have this formulated strategy, you should paper trade in order to see whether or not it's successful. With paper trading, there's no harm. You're not risking any money. So you're going to get a lot out of it because you're learning whether or not your strategy works. And at the same time, you can even tweak the strategy in order to adapt to the market changes and also create positive results. So here are just some examples of strategies that I use. If you look at this first chart, you can see a red to green breakout. So what I look for is the crossover where the stock opens. In this case, it was 260. So for this position, I got in at 260 and I looked for a 10-cent scalp. So I sold around 270, even though it ran all the way up to 350. You can see the second strategy that I use is the wedge breakout. This is forming higher lows and then there's a resistance level right there. Break of resistance causes this to run all the way up till about $2. Down here, you can see another wedge breakouts, higher lows, and then this resistance level over here, and break of that leads it up to 260. And in this chart, you can see a red to green breakout similar to the one over here. I bought where it opened up, and then I sold about 20 cents higher, but it ran all the way to $3. By playing these setups, you're able to be more consistent, and that's what matters. If you make profit one day and then you're taking losses the other day, then you're back to break even. But if you consistently make profit, then you're growing your account exponentially. Rule number 6, use resources. There's so many resources out there. You have Yahoo Finance, you have stock charts, StockTwits, Finviz. They're all there to help you and they're free. So why not spend your time going over them, reviewing different charts and having a look at what they have to offer? These are all available to you. You can spend your time. You can do as much research as you want and it's only going to benefit you. Use these resources to give you a competitive advantage over other traders because if you've done your research, then there's a higher chance that you're going to become more consistent and profitable. Alright, so that sums up today's video. I hope you got a lot of value out of this and learned quite a bit. If you like this video, be sure to hit that like and subscribe button below for future videos. And you can find me on Twitter, Instagram, and StockTwits. Just search for Trade with Alpha and I'll be right there. As always, you can also email me at tradewalpha@gmail.com and I'll respond as soon as possible. And I look forward to hearing from you and working with you in the near future. Stay safe and I'll see you on the next video.